So, you want to start investing, or you already have, but you're still not exactly sure of what type of stocks to buy. Today, I will go through a list for you on things to look for when buying stocks to help you outperform the market. These are lessons that I have learned from some of the greatest super investors of our time that I am now passing on to you. So, let's get straight into it with lesson number one, which is to know what you own. This was famously said by the legendary investor Peter Lynch.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
Testing, and now we go live. Peter emphasizes that you don't have to own very complex businesses to do well in the market. The problem with owning businesses you don't understand comes about when the company releases news or earnings and the stock begins to trade down. You won't know whether to buy or hold or to sell because you don't understand the business. You won't know if what just happened is another opportunity or if the fundamentals of the company are in decline. You won't understand the competitive nature of the business, and it will be difficult for you to forecast or predict its future earnings if you don't understand the economics of the business. So that's why you should only own businesses that you genuinely understand. Otherwise, you can so easily get scared out of a good position or lured into a bad buy. Warren also describes this ideology as staying inside your circle of competence.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
This now brings us to lesson number two, which is to look for a business with a moat. A moat is what Buffett describes as a business's competitive advantage. It's something the business has that keeps competition away and attracts customers to keep buying from them. The reason Buffett uses the analogy of a moat is because if you look at a medieval castle, it had a river around the castle that was filled with crocodiles and dangerous animals in there to prevent enemies breaking into the castle. So in the same spirit of the analogy, you should look for companies that have qualities that keep competition away and allows them to dominate the market. A moat can be either qualitative or quantitative or even both. Take for example, railroad companies like Union Pacific and Canadian Pacific have a quantitative moat. Canadian Pacific has approximately 20,100 kilometers of railroad that connects 7 Canadian provinces to the United States. Many logistics companies use their lines and trains to transport their goods in between the two countries. This company's moat is a high barrier to entry, meaning if another company wants to start running the same business, they will have a high startup cost, such as building new railway lines in another location that may not be as efficient as the lines Canadian Pacific already runs and owns. They would have the high cost of buying a lot of trains and inventory for them. So due to this, it's a big challenge and it makes it difficult for other businesses to come in and start taking market share from these two companies that already dominate the market. An example of a qualitative moat is one of the most valuable brands in the world, Apple. Apple has what is regarded as the best software integrated system across all their devices. The iOS system, which is obviously only unique to their devices, Apple's ecosystem means that once you get one of their devices, they integrate so seamlessly with their other devices, making the overall user experience so much better when you have all Apple devices, which optimizes the use of the device. This therefore makes it difficult for users to switch from Apple because of the friction from switching costs. The user already has all their data on their iCloud, and it's easier transferring the data across multiple Apple devices. Whereas if they opt for a Windows or Android system, it's a harder process to transfer the data, and other devices don't work to their optimal use with their Apple devices. Due to this, Apple has created very loyal customers across all their hardware devices. These customers are willing to wait and camp in long queues outside of Apple stores before new product releases. You know a moat is very powerful when a customer walks in a store and that store doesn't have their desired product, but it does have another brand that is cheaper, and yet the customer refuses that offer and is willing to wait and pay a higher price for their desired product. If you have followed lessons 1 and 2, it should directly lead you into companies that fit lesson 3, which is to find companies that produce consistent and growing free cash flows. Free cash flow is the money a business has generated after all expenses and cash outflows. This metric is very important because this money belongs to the owners of the firm, which are the shareholders, and it directly represents how profitable the business is. So the higher the number, the better it is for the owners. High free cash flows also give the business reinvestment opportunities. Whether the business wants to use it for an acquisition, which means buying a company, or projects within the business to make it more profitable, or do share buybacks, or maybe to even pay dividend to shareholders, high free cash flow gives the business the opportunity to do all those things. So it's very important to find a business with consistent and growing free cash flows. These companies' share price typically perform best as well. If you look at some of the best companies in the world, especially the best performing ones, they all have consistently growing free cash flows, which have been reinvested to do better, grow the business. This is what creates shareholder wealth over the long run. Free cash flows don't grow the same consistent amount every year. However, you must look for a business that over a 1, 5, or 10-year period, they have a consistent annual growth rate of around the high single digits or double-digit figures. Lesson number 4 is to look for businesses with high returns on capital employed, also known as ROCE, and capital is just a fancy finance term for money. If a business has high free cash flows, like I said in lesson 3, the business will then generate enough cash to reinvest to grow the business. And the rate of return the business gets from reinvesting is the ROCE. So the ROCE considers both debt and equity use. This rate measures the profitability and the efficiency of the capital employed, which essentially tells investors how effectively this business uses money. To better understand this concept and see the impact of it, we are going to hear from British super investor Terry Smith, the CEO and owner of Fundsmith, which has outperformed the market at a 15.6% per annum growth rate since its inception in 2010. Terry is a brilliant mind, and in this example, he compares the difference between two real companies. Company A that has a 20% ROCE and Company B which has a 10% ROCE. And this comparison is over a 40-year period. He shows how the difference of their returns on capital employed can have a big impact on the company's performance over the long run.
Company B makes a 10% return on capital. Just to save us a lot of sort of strenuous arithmetic, neither of them pays a dividend. They both invest all of their profits back into the business at the same rate of return. Okay, who wants to own A? This is a show of hands thing. B, anybody? Anyone want B? No, good. You've all been listening. Oh, there's a man with B over there. We've got a man with B. Well done, sir. Yeah. Not even my regular straight man. Good. Now, I haven't, of course, as ever with any question I ever pose, it's always completely unfair because I haven't given you enough information to answer the question. You need to know what value you buy it and sell it at, don't you? So here's what happens with these two shares. Not unreasonably, A, the 20% returner, is priced, the shares are priced at 4 times its book value. Whereas B, the 10% returner, is only trading at 2 times book value when you buy them. Okay, who wants A? Anyone want to join this gentleman on B? Can't see any. Oh, a couple of Bs over there. Well done, well done. Yeah, good. Okay, still haven't got enough information. How about when you come to sell them? Okay, when you come to sell them, it's all gone horribly wrong. If you bought A on 4 times book, the rating's halved to 2 times book. And that's a bit of bad luck, isn't it, really? It happens, I suppose. B, you've done very well. It's gone from 2 times book to 4 times book. The rating has doubled in the time that you sell it. Okay, who wants A now? Who wants B now? Oh, still a couple of B. There's your answer. If that was the portfolio the choice facing you, A, with a 20% return on capital, bought on 4 times book and sold on 2 times book, would give you a share price return of 18% per annum in compound annual growth. B, with a 10% return, even though you doubled the rating on which you bought it when you sold it, would only get to a 12% annual return in terms of share price. If you are going to be a long-term investor, and I hope you all realise by now we are on your behalf, whether or not you are investing in a good company that makes high returns and can reinvest in its business at something like those high returns is the single biggest determinant of the outcome.
Congratulations. You have now made it to the final lesson, which is one of the most important ones. And lesson number 5 is to avoid diversification, as Peter Lynch and Charlie Munger like to call it. Diversification is a protection against ignorance, as Warren Buffett says. If you don't know what you are doing, then it makes sense to diversify. Diversifying is conventional investing wisdom for people who want to do well but not put in that much effort. But if you want to be an active investor and outperform the market, like this guy, diversification is your worst enemy. You just did all the work from the previous lessons to find good companies. So why would you put your money in your 10th best idea when you can put it in your first, second, or third best idea? Staying concentrated in good positions will help you outperform the market. Here is what Chuck Akre and John Neff have to say about that.
Say, I'm not sure we are avoiding it. Now,
and the other part of my question should be, when I talked to you in 2014 that you had 30 holdings, you're now down to 17, you've got a ton more money. Shouldn't you have more holdings? So go ahead.
Right. So we always talk about our ability to do better than average.
Right.
And so when you think about average, so when I think about average, I don't necessarily think of our AUM. What I think of is our ability to stay concentrated. So give me an example. If you flipped a coin, the average outcome would be that 50% of the time it would be heads and 50% of the time it would be tails. The more coins you flip, the more likely you are to get to average. 50% will be heads. The fewer coins you flip, the more likely you are to get an outcome that deviates positively or negatively from average. And I think
so you're flipping coins, Chuck. You didn't know that. Okay.
So,
okay.
but that's what I mean by
So that's the philosophy.
So it's really not about our AUM. It's our ability to stay concentrated in our highest conviction ideas, and our AUM hasn't been a problem to date.
in 2014, if we had 30 or 35 holdings, we would have been at that point in time less confident in those names than we are in the 17 holdings today.
Okay.
So if you see our holdings go to 35 again, you should just understand that it means we are less confident in the characteristics of the group as a whole, and that's why we have it spread out. And then the concentration, pure concentration, is we want to have as much money invested in the great businesses as we possibly can, because our return will come from their good experience. We will be riding on the back of those great businesses. So that's why we want to have all this, our capital concentrated in those things.
So those are the 5 lessons for today. And in recap, we want to know what we own, look for companies that have a moat, look for consistently growing free cash flows, look for companies with high returns on capital employed, and avoid diversification. So that's all for today, guys. If you enjoyed the video, please drop a like and a comment down below. Subscribe to my channel to keep up with me, and I'll see you in the next one.